Hi there, Etoro. It is Monday the 11th of July, and it's time to take a look at what moved the markets last week. There's nothing amazing to talk about with regard to the charts. The NASDAQ was up on the week, the S&P 500 up on the week, so there was a little bit of a rebound. XLE, so the sector-specific fund that looks at energy companies in the US, is kind of flattish, trying to find some direction. I see a lot of people that are becoming very bullish on it, given the fall that we've seen recently. And probably the most interesting of the lots is the CSI 300. So this rally that we've seen in Chinese equities failed to break the 200-day moving average for the CSI 300 at least, and is now crawling along the support that it's been moving up with over the past few months, and there are a few reasons for that. We'll take a look at a few of those in a moment. In terms of the goings on last week, well, it was a holiday on Monday in the US, so things were quite quiet there. There weren't any enormous surprises last week, except for on Friday we saw that non-farm payrolls came in much higher than expected. So this just emphasizes that in June the job market in the US is still quite hot, and the Fed is committed to taking some of that heat out in order to bring down inflation. In terms of commodities, so I would say the mood of the markets through the past week has been cautiously optimistic. So it feels as though most investors feel as though we're reaching peak inflation, or peak inflation is just behind us. Commodities and companies involved in commodities seem to be signaling that. And I think the pickup in activity in China has also been a secondary effect, because China is the world's factory, and a large amount of activity in China could bode very well for other economies, considering how connected the world is. Over the past week or so, we have seen a lot of commodities continue their decline, so you can see this is a pattern that's been holding for a while now, although we are seeing the price of natural gas, although I think this is a US natural gas tick up. The prices for natural gas, by the way, are highly localized. I'm looking at the US picture. So in places in Europe, the price of natural gas has only been going up for a while. I think probably the most key thing that people are watching right now is the price of oil. So the price of oil has become highly correlated with inflation. And so a tempering of the price of oil is being seen widely as a sign that inflation is cooling down. Now, in terms of what's going on in China, now, unfortunately, the Chinese policy towards coronavirus is gonna just continue causing a problem within their borders. So now we're seeing variants of variants create outbreaks across the country. So there are lockdowns happening all over the show in China at the moment, and we're feeling that a little bit today in the stock market. We also did see some good news. So China continues to try and stoke the embers of growth within their economy. But on the flip side, there are a whole bunch of new fines that have been issued for some very large businesses, which has hit these tech companies' stock prices today. Many are also waiting for Biden's ruling on the tariffs that were imposed through mostly 2018. And the US, under Trump, imposed tariffs on a number of countries, but most notably China. So it has been said that Biden is likely to roll back at least some of the tariffs in order to bring down inflation. But there are pundits out there saying that it's not going to have a very large effect on inflation overall. People taking the opposite view, of course, but Biden seems to be taking his sweet time on this one. Of course, if those tariffs are removed, some of those tariffs are removed, then it would encourage people to buy in the US more stuff from China. While we're on the topic of tariffs, now this one flew under the radar a little bit. I'm not sure if you know, but there have been tariffs for US imports of Canadian solar products for a few years now. Now, obviously, this means that importing Canadian solar products into the US has been more expensive for a while. And then I think it was early last year that Canada and the US started discussing this. So you can see this kind of thing takes a while to actually happen. The discussions have been going on for more than a year now. Now, this is great for one of my favorite companies and a company in my portfolio, Canadian Solar. So this is a fantastic company. They are a pretty large player within the solar industry. You can see their revenue is $5.5 billion, and their share price is just at a very, very difficult time. And this is despite the fact that, I mean, you can look at lots of their valuation multiples, very low PE ratio for the industry, the PEG ratio less than 1/2, which means it's a very fast growing company. EPS growth is enormous. Return on capital is fantastic. Return on capital is fantastic versus the industry and the market. If you look at the total revenue, you can see that it has been growing excellently over the past 5 years and is forecast to continue to do so. Their profit has taken a bit of a beating through the past few years, but that's been the case for all companies in this industry. Supply chains are very important to solar companies. And so all the supply chain issues that we've seen through the past few years have really hurt margins, but it looks as though the investments that Canadian Solar has made will see them netting a huge profit in the years to come. The company is carrying some debt as they have been growing, and this is one part of the company that you need to keep an eye on. Now, these numbers don't tell you that much about the actual operations of the company. This is an enormous, global, diversified company. They have a subsidiary that is in the process of listing in China. If you follow the news of this company, they're constantly closing enormous projects with very large companies and utilities around the world. And now the lifting of these tariffs is bound to have a good effect on these net profits and margins for the company. Now, a lot of solar companies, I think, are very expensive still, even after the large decline that we've seen through the past half year or so. But Canadian Solar is pretty damn cheap. But I would say that because I own it. We also had Boris Johnson. You can see his full name here. First name actually Alexander. He resigned on the 7th of July, and we're still in the process of finding out who his replacement would be. Of course, this is not great, given the state of the UK and the world right now. We have the pandemic still roaring on, enormous inflation, growth problems in the UK, the knock-on effects of Brexit appearing all across our economy. So let's hope his replacement is a little better suited to the job. Now, there were some short-term effects when this announcement was made. The pound strengthened slightly, the indexes jumped slightly, but I looked at all of those gains today, and it seems they've given back just about all of the gains that they made on the day. Now, in quite a few of these videos, I'll talk about all the various cycles that the market experiences. And this is one that I've walked through before, this market structure, the 4 phases of the market. So there is the accumulation phase. This is after there's been a bear market or a huge decline. The markup phase, where parts of the market or the whole market are running higher distribution, where seasoned investors tend to get quite nervous because they've just been through the markup phase and things that by this point in time will probably be quite expensive. And finally, we have the decline phase, the phase that we've been in for a while, and each of these are broken up into subcategories along the bottom. Of course, the world is never as simple as a diagram like this tries to make it appear, but it is informative nonetheless. Now, the last time we looked at this chart, I think we were probably somewhere towards the end of distribution, maybe the early part of decline. Now, what's quite interesting about having this knowledge is that it's easily applicable to many charts. You can go back in history and you'll see, the same thing happens over and over again, but it's also good as another tool to try and figure out where we are in the market. Starting with the ARK Innovation ETF, so one of the areas of the market that was the hottest on the way up, and then the coldest, the hottest on the way down. We can see that starting around 2020, 2019, after that March 2020 crash, this ETF just took off. And so it's quite easy to see this full shape played out for the ARK Innovation ETF. The price level for this ETF is now the same that it was going back through to 2018, and it looks as though this might have played out in its entirety. So what I've noticed going back through historic examples is that quite often when this shape plays out for the most volatile of assets that do survive ultimately for the long term, the final price tends to be somewhere near the initial price when the cycle kicked off. So what the various forms of this diagram teach us is that we are now probably in store for a multi-month period of sideways consolidation. It looks as though it might have started, and the 200-day moving average will slowly move closer and closer to the particular price action. Once the price of a particular instrument breaks that 200-day moving average, you're then considered to be back in the accumulation phase. Now, it's not just the ARK Innovation ETF. We have seen this. There are various assets where this type of price action has played out. So NVIDIA, as another example, it went through that enormous rise in price action, moved kind of sideways, slowly downwards for a while, and then completely fell through the floor. NVIDIA is a company that is not going to die during this bear market. This is the world's leader in certain very popular types of semiconductors, GPUs that are used in gaming, artificial intelligence, electric vehicles, self-driving vehicles, etc. NVIDIA is the undisputed leader. The share price got incredibly hot, some of that heat was taken out, and we can see the cycle play out in the price action. If we look at Google, we can see here too that something similar has played out. It's a little bit different when it comes to the mega caps because they are safe havens, so they don't tend to be as volatile as other smaller companies. So I don't necessarily think the price of Google stock will go back to where it was at the beginning of their previous bull run during that markup phase. But you can see that shape has played out more or less here. And then looking in a completely different market, so we can see 360 Digitech. This is a Chinese company. They're a middleman between lenders and the public in China. And again, we can see that same shape has played out here. So it doesn't fit as neatly as, for example, ARK's Innovation ETF. This would be a textbook example, but you can see that the shape is more or less there. What's quite interesting here is that the price action, you can see it has attempted to take the 200-day moving average, but wasn't successful. Now, when it comes down to it, I am a fundamentals bottom-up investor. So it might seem unusual that I look at these types of things when performing my analysis. But that's not true. I think any tool that you can find that helps you, give you a little bit more information about, in this case, the overall market psychology, is definitely a valuable tool to use. I wanted to touch on this thread on Twitter briefly. This is from a guy called Brian Stoffel. So he's worked for the Motley Fool. The Motley Fool are, of course, being a very famous online publication for investors. And Brian Stoffel's approach to investing is very similar to mine. I think that I need to make a separate video just specifically about that as a reminder for my copiers. So in this thread, he is saying that he holds a number of companies that are high beta companies. And over the past 10 and 5-year periods, he's beaten the S&P 500 by a wide margin. And this is the same case for me. Over 5 years and 10 years, I've clobbered the S&P 500. But if you look at his short-term results, his 3-year, 1-year, and year-to-date results, he is losing to the S&P 500. This is similar to my situation too, although I think I'm beating the S&P 500 on the 3-year time period. He goes on to say that this is not something that is worrying him. This is just the way the market works. This is the cycle of the market. And the situation that you want to be in is that despite losing to the market year-to-date, or for the last year, or for the last 2 years, 10 years down the line, you want to look back and see that you have clobbered the market once again. Now, it's very difficult to predict price action in the short term, but if you look at the companies that you invest in as businesses that you are owning a share of, you're not just participating in a gambling machine, you're looking at a company and you're becoming an investor. And in looking at each of those companies, you look at the management of those companies, the strategy of those companies, the products they have, the track record as a business. It's interesting to look at the numbers that they put out in their earnings reports. You might even get some value from looking at the price action on TradingView or whatever you use. But a company is more than just these two things. And so if you can find companies that are going to be, he calls them anti-fragile, but companies that are going to last for the long term, and not only last, but outcompete just about the rest of the market that they participate in, then the short-term movements and price action don't matter. Because ultimately, following every bear market is a bull market. And if you own the best businesses in that bull market, you will do better than the market in general. Alrighty, what about this week? We've got some very interesting pieces of information coming out this week. So for the UK, we are seeing the GDP numbers, but probably the thing that the market is most interested in this week is the core CPI and CPI numbers out of the US. The market is, of course, hoping that this comes in lower than is expected. And if it comes in higher than expected, I expect we might see a bit of a sell-off once again. The other thing that investors are keenly watching this week are earnings. And so you can see that the big banks in the US will start reporting towards the tail end of the week. The reason earnings are particularly important this earnings season is because most people feel as though the market has priced in a slowdown in the economy, but still a small amount of growth in earnings. And so if we learn through forecasts from earnings through the next few weeks that earnings through the rest of this year are not growing by as much as expected or are declining, then we might see another leg down in the market. There's no way to know if that's going to happen or not, but even if it did, I've got a feeling that this would be the last part of this bear market. All right, that's it for this week. Have a great one, and I'll speak to you soon. Goodbye.